So, good morning, everybody. Thank you for attending this meeting. This is a webinar. I think it's a great one. Um, it's um, it's temporary buy downs, and I think that I'm safe to say that I think that we have achieved the turning point in the mortgage on the increase of the mortgage rates because um, we just received the first CPI reporting showing a decline in CPI index, and that was a post that I just did on my Instagram. Um, I think it's less than an hour ago. The last CPI reporting was zero point 0.6 last month, and it came back at zero point 0.3. The forecast, it's the forecast, it was zero point 0.5, and it actually came back at zero point 0.3. So that shows how inflation is slowing down and is actually improving. Okay, so having said that is a turning point for interest rates because interest rates went up because it's the only way of inflation coming down. Okay, and because this is happening right now, because this it just happened. um I think that we will see um rates will start coming down, and this is the point where everything changes, you know, and and here's where everything is going to start changing. And as a matter of fact, the market, give me just one quick second here. um the market is where the market is going to start changing. As a matter of fact, guys, the market just went up, and I'm accessing this on my phone right now, so I can give you an accurate number. The market, it's the mortgage yields are up 145 basis points since this morning when we received that information. Okay, so it is a big thing, and I think this comes just perfect. This presentation comes at the right moment. So let's get at it. Temporary buy downs, 2-1 seller paid, and I will tell you all about this right now. But for the ones that don't know me, my name is Noel Beitia, and from DG Pinnacle Home Loans, we are a direct mortgage lender in South Florida, Texas, and Louisiana, Alabama, and California. And we specialize on residential, FHA, USDA, BA, non-QM, foreign national, reverse mortgages, and we also have commercial, some stated commercial products. We specialize in home financing, but more than that, we specialize on first-time home buyers. So the objectives of this presentation today is learn the current market data, understand the temporary buy down options, and how to apply the temporary buy down solution to the current market for listing agents and selling agents. Okay, and of course buyers and sellers too. So first of all, I want to share some data with you. This data was until October 1st, 2022, right? And this is the regional listing price in Miami-Dade and Broward versus the sold price. So as you can see here, and guys, if you have any questions, just ask me as I go with my presentation. As you can see here, here's where properties were listing at, okay, the prices, and here's where properties have been selling at. So we are already seeing some of the prices going down, some of the prices adjusting because of the high interest rates. Okay. So here's another one: days on the market versus list price median. Give me a second, somebody's waiting. Let me give them access. So here's the the days to sell in the market. So we saw an increase from May all the way through July, August, September, and I wasn't able to pull November, October yet, but I'm sure that that number has increased. So now it's taking longer for you to be able to sell your home in the market. And this is just Miami-Dade and Broward. It was just too much data to obtain for the entire state of Florida, which I know some of you are up there. But this is another indication how the market is slowing down and what's happening in the market. You can see the lease price and median price fluctuating here a lot, but that's not a big number. And here's the active listings, guys. This is what tells you that we're still in a seller's market, but we're in a transition to a buyer's market. And this transition could be just because rates are going up, just because listings are sitting in the market. If we see if we see how many listings we had in January of 2022, we had 7,837 listings, active listings in the market. September 2022, 19,929. Guys, this is because of the high interest rates. Okay? So for that reason, properties are sitting in the market because what happens when rates goes up? What gets affected? It's affordability. Okay? People can afford less homes when rates go up because the monthly payment goes up. Okay? So what is a temporary buy down and what's the solution that this brings to you? A temporary buy down, it is an effective interest rate the borrower pays is reduced for a specific time period. Interest rate is reduced by paying an upfront fee, which is placed into a buy down account. Portion of the upfront fee, it's allocated each month to reduce the borrower's payments during the buy down period. Okay, so guys, why should I use a buy down? And I'm gonna get into a better explanation of that just for you guys to understand. As a matter of fact, let me second. So in other words, guys, effective interest rate the borrower pays to reduce for a specific time period. So on a 2-1 buy down, I'm going to explain this to you. On a 2-1 buy down, okay, the client has a reduced interest rate for 2 years. So let's say the note rate it's 7%, okay? So the first year of that mortgage, let's say the client closed at a 7% interest rate. The first 12 months, the client is going to pay the mortgage at a 2% discount. That means that he's going to start paying the mortgage at 5% interest rate for 12 months. Then on the second year, okay, on the second year, the borrower pays 6%, okay, during, for the entire year. And then on the third year, the mortgage, the interest rate goes to the note rate, which is 7%. Now, interest rate is reduced by paying an upfront fee, which is placed into a buy down account. So that 2% discount, who's paying for it? The seller, or the seller could pay for it. It cannot be from the buyer's fund. That's why it says it's a temporary buy down where the sellers contributes towards closing costs. Now, what is better for a seller, guys? Is it better for them to continue to drop the price or to advertise the house with a temporary buy down, okay, instead of lowering prices? I mean, I've seen in most of the listings that you guys had, how prices have been decreasing, trying to hit that market where the buyers gets an incentive to put an offer. So it's better to offer to market your listings or to educate the sellers to give you a seller contribution so that the buyer can have a more affordable payment. Okay. So what we do with that money is to allocate that money into the escrow account and to fund that difference between the interest rate, okay, and the mortgage rate every month. And down the presentation, we'll explain this in a better term. So, we have some examples here for you guys to understand. So why use a temporary buy down? Because we're giving more affordability in a rising rate environment. Okay. And basically, the seller can prepay all of the buy down. Actually, the seller has to prepay all of the buy down because it is not acceptable from the buyer's side. Okay. So guys, instead of lowering the price, we still got to take advantage that the properties are appraising, right? Properties now appraised, but the problem that we have is that buyers are not willing to pay that much because the interest rates are high and they're not able to pay that much monthly. Okay, so we can take advantage of that the properties are appraising and apply that seller concessions. Okay, it's not that much of a money. Okay, so the average cost on a 2-1 buy down is about 2 and a quarter. Okay, for so let's say if you're selling a house for $100,000, just to say a number, it is about 2250, that cost of 2 years. And the good thing about this is that in those 2 years, the client, if rates go back down, client can refinance and apply all the buy down funds on that escrow account towards the principal reduction. So it's a win-win for the buyer, and it's a way to incentivize the buyers to do this. Okay. Now, what is the difference between temporary buy downs and permanent buy downs? Not sure if you guys know what a permanent buy down is, but it's usually when the client buy discount points, okay, to lower the note rate. Okay. So in this case, we could do both. We could do the temporary buy down, which is, second, somebody else is waiting. So the temporary buy down, it's for a short period of time, and the rate is increased each year until reaching the actual interest rate. A permanent buy down is when discount points are paid upfront and permanently lower or buy down the interest rate and are paid as a percentage of the loan amount. So in other words, a permanent buy down is when you get a 7% interest rate and you want to buy down that rate for the life of the loan to, let's say, 6.75 or 6.5. You might have to pay 1% to get that buy down. Okay, but that could be paid from the borrower's fund. The temporary buy down, it has to be from the seller or a developer. Okay. So the temporary buy down, the product requirements are for conventional, Fannie and Freddie. So we could do conventional with 3% down, 5% down, 10% down, 20% down. It doesn't matter. Okay. And for government, we can use it for FHA loans, 3.5% down, VA, 100% financing, USDA, 100% financing. Okay. The minimum credit score required for us is 620. We will do it only on fixed rate products because you're going to start seeing a lot of ARM products coming out to the market. We would only, as per Fannie Mae, we're only allowed to do this on fixed rate products, owner occupied only, purchase only, and we can do it on single family residence, plot, and condos. Okay. Maggie, you have a question? I see that you're raising your hand. Yeah, give me just 1 second. Let me allow your microphone to go on. Okay, go ahead. You have a question?
Okay. Hey, Noel. Yeah. So, you said for the permanent, it has to be paid by the buyer or can also be paid by the seller?
The permanent buy down can only, let me go back here so I can clarify this for you. The permanent buy down can be paid by either buyer or seller. It really doesn't matter.
Okay.
Okay. The temporary buy down can
Must
only
be by the seller.
funded by the seller.
Yeah.
Okay. All right. So, basically, guys, this is really important. So the temporary buy down option requirements, a 2-1 buy down is a 2% reduction on the first year. Okay. 1% reduction on the second year. The actual note rate on the third year. It's seller paid only. Borrower paid is not allowed. Now, the clients still have to qualify on the no rate. And the reason being is because after the third year, if rates don't go down, which I doubt it, we still have to um, make sure that the client can make those payments. So for that reason, we still qualify the client on the high rate, on the no rate. Okay. So now, how do you guys can do this on a purchase contract, right? So basically, what needs to be done. So what I tell realtors, keep it simple. Just do at the time of the offer, just request seller concessions. Just ask the seller for seller concessions. Go in on your negotiation. As a matter of fact, this is something so new that we just did one with one of my realtors. She went in and she asked for 3% seller concessions. Guys, this was funny because when she did that, the realtor, the listing agent said, "Oh no, no way! In this market, we're not gonna give you seller concessions. We have multiple offers." They counter back at a 2% seller concessions, and at the end of the day, they gave the concessions. There is no multiple offers anymore. You might get one deal that is the cheapest, the lowest house in the market in Dade County, and yes, you might have multiple offers, but most likely there's no more multiple offers. Mortgage applications have dropped more than 70%. Okay,
No,
70%.
Noel.
Yes.
Okay. No, absolutely. The whole multiple offer situation that's not happening like that anymore. I mean, if we can get two offers, we're lucky enough. But I'm a little confused. Like if I get an offer and I see that this buyer's agent is asking for 2%, I mean, how do we know how much money is that really translating in reference to seller's concessions, because they're not giving an exact amount. Like when I ask for seller contribution, I'm asking for a specific amount. So for this purpose of using the money to bring down the interest rate, like how do we calculate how much money we should be
Well,
asking
that's
in that
that's what I
specific scenario?
yes, that's what I said. So if we're doing a 2-1 buy down, right? If we're
Mm-hmm.
doing a 2-1 buy down, the average cost, it doesn't matter the rate, the average cost is about 2.25%, 2.25%
Okay, so
of the
that
loan
that's
amount.
for 1 point of the
That's
loan amount.
for the 2-1 buy down, which is 2% reduction the first year, 1% reduction the third year. Okay. So now, why do I say first of all go in with 3% seller concessions? Okay, because they're gonna counter back. Okay, and it has to be 100% financed, but funded by the seller. So my advice is negotiate, go in with 3%. If you get the 3%, great. Borrower can use the other 75 bips, the other 0.75 towards a permanent buy down, or for the
I'm
rest of the closing costs.
I'm still lost. I'm sorry. Maybe I'm not good doing the math just like that in the middle of the presentation. So you're saying each point is $2,000, 250, or like what's the exact dollar amount?
Yes, 2.2, for example. And I'm gonna get to that, Maggie. Let me get
Oh,
to
okay,
that part
okay.
of the presentation, and you'll see how do we calculate this. The problem is that until we don't lock the rate, we're not able to tell you exactly how much it's going to cost. Okay,
Mm-hmm.
so for that reason, I cannot tell you exactly how much it's going to cost
Of course.
until we don't have a final contract and we lock the rate. So for that
Okay, so
reason, I'm saying
that's why
yes.
when we're asking for the concessions, we shouldn't be putting a dollar a month, just putting
Exactly, until we
into.
lock the rate. And in order
Got
for
it.
us to lock the rate, even though we have a lock and look, okay, we have a program that is lock and look, okay, so
Mm-hmm.
we can pre-quote the client and we can lock the rate for up to 120 days, okay.
Yeah.
I don't think it's gonna be something that we're gonna be using a lot now because I think rates are gonna start to go down. But yes, we can do lock and look, but we cannot calculate how much is going to be the seller concessions until we have a fully executed contract and we're able to lock the rate.
Mm-hmm.
Okay.
Mm-hmm.
So for that reason, I just I'm telling you guys just to go ahead and request a seller contribution because this program, the temporary buy down, does not allow you to exceed the maximum seller concessions allowed on the loan. So what does that mean? That means, for example, on conventional financing, anything below, above 90% loan to value, so it means 10% or less, maximum contribution is 3%. Okay? On
Mm-hmm.
FHA, the maximum seller concessions is 6%. And same for BA and USDA. Okay? So the standard interest party contribution cannot be exceed. So that's why I say, depending on the pre-qualification, I will be able to explain to you how you come in and you negotiate that deal and how much to request. Okay? So what
Mm-hmm.
needs
Mm-hmm.
to be done is we need to sign, once we lock the loan, the seller and the buyer needs to sign a buy down agreement. Okay, it means the seller it's contributing a certain amount of money towards the borrower's buy down, but until you don't have an executed contract and you don't have and until you don't have the loan locked, we won't be able to tell the seller how much would that be. Okay. So here's the example so that you guys understand. Okay. So this is an example of a 500,000 loan amount. Okay. Out of 5%. Okay. And this is a 2-1 buy down. So the loan amount is 500, interest rate is 5%. Okay. The monthly rate of the cost of the buy down is 0.42. So because in the first year, the interest rate is going to be 3%, the total monthly payment was supposed to be at 5%, 2,684. But at a 3% interest rate, it will be $2,108.02, right? So the monthly cost of the buy down in this case is $576. So the cost annually, in this case, it's 6,913. Second year, it's 4%. So the difference is $297 a month, okay, for a total cost of $3,564, okay? So that means that the total amount of the buy down in this case, which the loan amount is 500, it's 10,474. But
Mm-hmm.
now 500,000 is the loan amount. How much is the sales price? The sales price might be 525, might be 530. Okay. Hold on. Somebody else is asking for the microphone here. Ariana. Okay, I see you here. Allow mic. Perfect. So you are open now, Ariana. So in this case, the cost is 10,477. If the purchase price was, for example, 530, we divide that amount by 530, $10,477.44 divided by 530. It's actually 1.97% in this case. If the purchase price was 530, if it was 600 and the client was doing 100,000 down, then it's even less money, right? It's 10,477 divided by 600,000 is actually 1.74% of the sales price. So, as long as you get more, it's not a problem. So you usually can do, when you're negotiating a contract, you can do 3%, 2.5% towards buyers, closing costs, and prepaid items. And then once we lock the loan, we will ask you guys to do an addendum, reducing, changing the contribution exactly to some. For example, in this case, 1.91 towards buy down funds, and the rest of that towards the rest of the contribution towards the closing costs and prepaids. Any questions on that? Any question on that? Just to make sure that you guys
No, no, no,
understood.
no. So basically, one. Okay, so when we're negotiating, okay, so in this scenario, whether you're the listing agent or the buyer's agent, so we negotiate at the beginning. We just put, we're asking for 2%, 3%. What's it called?
Seller
So
concessions, seller
seller
contribution.
concessions, yeah, seller contribution. But only once the interest rate has been locked, because obviously you can't lock it at the beginning. Once it's already been locked, that's when we do the addendum, and at that point we put the exact dollar amount, right?
Exactly.
Okay, yeah, I got it. That's where I was getting confused. So you don't know the exact amount at the beginning, obviously, because you can't you don't know the interest rate. It hasn't been locked yet. So okay, no, I got it. I got it.
That's correct. So, and this is another example of what's called a 1-0 buy down. So, for example, this example is $750,000, where the note rate is at 6%. Okay, on the 1-0 buy down is only 1 year, and that 1 year it's reduced from 6 to 5. So the total cost is $5,645. So let's say that you guys were not able to get a 2% concession for some reason. Well, you got only less than 2%. We can always do the 1-0 buy down. Now, if you're able to do 6% on an FHA loan, I can go and do the 3-1 buy down, which instead of 2% discount is 3% the first year, 2% the second, and then 1% on the third year. So, guys, the most important part here is let's pre-qualify your clients first. So after we pre-qualify your clients, then we're able to tell you exactly and to create a strategy with you to help you fund that client and to get the best deal for the client. The good thing about FHA is that on FHA, let's say the client does a 3-1 buy down, and he got on a 3-1 buy down, that client has, let's say on a purchase price of $400,000, $12,000 on buy down funds, and the rates go down 6 months from now. Guess what's going to happen? We're able to refinance that client and applied all that money on the buy down funds towards a principal reduction. So it's a win-win for the buyer. So which is the one that it might be your client or not. It might be your client or not, but it's a win-win for the buyer because not only he got a reduced interest rate for the first 12 months, but then he was able to refinance and apply that money towards a principal reduction. So it's much likely he got the property reduced in price. So it is a win-win situation for them. Okay. So like I said, there is no specific language for a temporary buy down on the purchase contract. We will I will send you a buy down agreement for you to read it and to understand what a buy down agreement is. But at the beginning, by just asking for seller concessions, that should be enough for you guys to be able to get that contract started. By that time we should have the client already pre-qualified, and like I said, we now have that lock and look that we can actually lock the client for 120 days. If the market gets better, we can always negotiate that lock. So I really recommend you guys to talk to your clients. Buyers are getting discouraged just because rates are going up. It's getting really unaffordable. This is a way of you calling your clients now and say, hey guys, we have temporary loan buy down. We can get you a lower rate for the next 2 years or 3 years. Rates are going to start going down because we see inflation already going down. Okay, so Barry Habib said, and Barry Habib, by the way, is one of the most knowledgeable guys about mortgage bonds and bond security. And he said that by first quarter of 2023, we should see the rates anywhere between 5 and 6%. Guys, right now I've seen up to 8.25% on a fixed 30-year loan. Okay. Yesterday we were able to lock loans at 6.5%. So market is getting a lot better. I think that we're gonna be fine on the first quarter of 2023. But we gotta finish this year strong. I really recommend you guys to apply these solutions to your buyers. If you have any questions or or if you didn't understand something in a specific, just contact me. Let's do a one-on-one to go over again. I'll be more than glad to do that. And right now, let's open for questions. Some of you had questions, so I'm gonna bring my other screen because I'm working on only one screen. That's why I didn't see if someone had questions before, so I can open the microphones here. I have a lot of microphones closed that I gotta open now. So if you have any questions, this is the moment for you guys to ask me, please.
I have another question, Noel. It's Maggie.
Okay.
So, but the buyer has to qualify at the high interest rate. You guys don't do all the, because I think we spoke about this.
Yes,
So
the buyer has to
they're not, yeah,
qualify at the no rate.
at the note rate. Yeah. Okay.
Because if something goes wrong and we continue to be on the inflation numbers that we are, he got to be able to qualify on the third year at the interest rate at the note rate, basically.
Of course. Okay.
Okay, guys. Any other question? Anybody else? Okay, I hope that you guys understood and enjoyed this presentation. If you guys have any other question, don't hesitate to contact me. You know my contact information, and I'll be more than glad to help you. All right.
Thank you, Noel.
All right. Have a great day, everybody. Bye.